These are some of the most impactful mortgage rule changes that we've seen come down in years, and they were just launched. On December 15th of 2024, the brand new mortgage rules took effect in Canada, and they're gonna send shockwaves through the mortgage rule industry. And make no doubt about it, these rules are pretty substantial. Some of them have been asked for years, and others were never really asked for, but now they're presented. So the question mark is, how do these new rules impact you? And more importantly, how do they break down specifically? So we'll dig into specifically the new rules, which include the following: CMHC's new ability to qualify with less than 20% down payment on a property up to $1.5 million. And the second option, which is the ability for you now to do a 30-year amortization on both new builds and non-new builds or resale properties for first-time buyers, as well as brand new builds for any home buyer on a 30-year amortization. Now, on top of that, we're gonna sneak in a sneaky little update on the uninsured no stress test switches. That was a mouthful, but there's a lot to cover here today. So let's get into explaining how these programs work and how they might impact you. Now, one of the biggest, most groundbreaking changes that Chris McFadyen announced in the summer of 2024 to take effect on December 15th was a change to CMHC's guidelines, which allows for people to put down less than 20% for the first time in almost 10 years on a property of above $1 million. Now, make no mistake about it, back in 2016 and 17, this wasn't a substantial issue because so many properties throughout the country were available under $1 million outside of the core cities like Vancouver and Toronto. But now almost all suburbs of these communities, and in many situations, other cities throughout the country, are dealing with house prices above $1 million. And in many situations, for not even detached houses, but townhomes. And that's locked families in, otherwise who have the income to be able to qualify, but don't have the ability to access the money required for a down payment into homes that might not otherwise suit them. And with these new rule changes in effect, it's going to open up the ability for many Canadians to be able to finally make that upsize situation into a home that might better suit their needs, and essentially start shifting the bar in the real estate market price point from $99999 up to $1.5. Now, let's first of all explain how the new rules work and specifically who it impacts. So here's exactly how the new rules work. First and foremost, you can now qualify to purchase a property up to $1.5 million with less than 20% down, but here's the breakdown. The down payment rules are the same as they are on any other property, which is 5% or $25,000 on the first $500,000. For anything above $500,000, you require 10% on the amount above that. So for example, if you're purchasing $1 million property today, you need $25,000 on the first 500 and 10%, which is $50,000 on the remainder. That means on $1 million purchase price, it's a $75,000 down payment. Now, if we were to fast forward that number up to $1.499999, so $1.49 million, your down payment is effectively $125,000 if I'm rounding up. And that's because you're doing 5% on the first amount and 10% for the amount above that. Now, what a lot of people are asking is, okay, well, who would again want to do $125,000 in insured mortgage on a property of up to $1.5 million? And I think the answer to that question is reasonably most people that earn a high amount of income who live in an expensive city but haven't either been able to save the money because maybe they're paying back student loans, or B, because it's just an expensive proposition to live in our city and it would take them 10 years to save, let alone being able to trade up. Now, I've already seen quite a few people who are looking at the opportunity to actually do something else, which is co-buying together with family members who are pooling in the resources. And maybe they're not putting the minimum down, maybe it's $150,000 or $200,000, but it gives them the ability now to be able to leverage to purchase a property with less than 20% down on a property at that price point. Now, a couple other notable things that you need to know if you're purchasing a property. You can combine this with the new rules around the 30-year amortization, as long as someone is a first-time buyer or it's a new build property. We'll talk about the first-time home buyer benefits in just a minute, but this is something that you can combine together. And as it relates to being able to purchase a property under insured program, you still have to qualify under the standard guidelines. And so if you don't have the ability to qualify for 30 years because you're not a first-time buyer, or it's not a new build property, under the CMHC guidelines, this needs to be a primary residence or a secondary home as considered under the CMHC guidelines. It needs to be one where you qualify under 39% of your income when it comes to your debt to income ratio. It basically means that you can borrow up to 39% of your income under your gross income relative to the debt, strata fees, and heating of the property to qualify for a mortgage. Now, as it relates to any other debt, you can't have any more than 44% of your income allocated to all of your debt, plus your housing expenses, as I just explained it. Now, a few details that you need to know about this program. Again, 5% plus 10%. The second thing is, again, anything a penny over 1.499999 cents is not qualified in this program, just like it used to be up to $1 million. So as soon as you hit 1.5 million or higher, you now have to put 20% down. There are no exceptions to that rule at all. Now, a lot of people are asking the question, which lenders are going to be allowing this program? At this point, it looks like virtually all lenders will be allowing the $1.5 million, although not all of them will be releasing the funds at the same time. Some have indicated that they will be ready day one to be able to approve clients, which we have access to on the new rules, whereas other lenders have advised us that they do not have the funds sourced and ready to go for the $1.5 million rules. Now, that's just one of a couple of big rule changes that have been shaking the industry, and we have plenty of clients who, believe it or not, are waiting for this. And the bigger one, I think, is the amortization rule changes. Here's how that actually works. So if you're buying a property and you're a first-time buyer, as long as one of the people on title is a first-time buyer who will be occupying the property, you can qualify to do a 30-year amortization on your new mortgage, which is significant because of two reasons. Number one, it has almost a 10% reduction in your monthly payments. And number two, it means you can qualify for more as it relates to a property, around 8 to 10% additional buying power on a mortgage. So the reality is a lot of people are thinking of using this program specifically, not just to be able to have lower monthly payments, but to be able to qualify for more. And my thoughts on this program is it's well overdue. But in addition to that, the program itself is most likely going to start to raise the bar as it relates to entry-level real estate. Meaning, because you can now qualify over 30 years, people on the bottom are going to purchase into those properties, and it might force the bar up as far as the entry-level price point, but not immediately, as it'll take time. So walking through some potential benefits of this program right here as it relates to the 30-year amortization. So number one, an example of a $500,000 purchase price at a rate of 4.59%. Monthly payment would be $2,522 versus $2,764, which is about a $220 difference in your monthly payments. That's a pretty significant amount of money to add back in your pocket, especially when it relates to things like strata fees, utilities, and other expenses. Number two, as I mentioned before, you can get additional roughly 8% more borrowing power. So that's $8,000 in every $100,000 of borrowing power. And when you compound that effect up to $800,000, it starts to really add up, and it can change the type of property that you're actually purchasing. Number three is the flexibility. The reality is a 30-year amortization gives you the flexibility to choose what you want to do with your monthly payments. Think about this. If you have more monthly cash flow, you can decide, do I want to contribute to my mortgage? Do I want to have the flexibility to have a better lifestyle? Do I want to invest that money? And then maybe make lump sum payments or balloon payments when the time is right if I want to pay it down faster. So it creates a little bit more flexibility from a lifestyle perspective. The fourth one is the reality is, let's just talk about lifestyle. In a city like Vancouver or Toronto, it's expensive to live. And so to have the ability to give someone the 30-year amortization gives them the ability to, of course, afford more, but just generally speaking, have a better quality of life. It's expensive enough to live in these cities. And so for any people, they want to have the chances to live a better life in these areas and locations with a lower monthly payment. As a reminder, you must have at least one person on title who is a first-time buyer. And if you're not sure about a first-time buyer, you should double check with the insured guidelines or reach out to us directly. You have to fall within the criteria of insured mortgage, which is under $1.499 million. In addition to that, you need to be occupying the property or have it as a second home. The key to this program, in summary, is more flexibility, more qualification, ability to get into the market right now and get some value before the prices start coming up, and just genuinely speaking, providing a much more flexible lifestyle for people who are purchasing properties with a low down payment to get into the marketplace today and not be completely shocked as it relates to their down payment. So the third big rule change that no one is talking about is the new stress test rules and guidelines. And this one can be a little bit confusing. Now, if you don't know already, for most people, when they took on an uninsured mortgage and they didn't qualify, an uninsured mortgage is one which was over $1 million, a 30-year amortization, a rental property, and many other details. Those are the primary ones. At the end of the term, you would have to re-qualify if you wanted to switch lenders, which meant that your current lender really had the leg up and you didn't have the option to go anywhere else. And so effectively, with the new rule changes, people can now choose to switch to another lender without being stress tested. You still have to qualify for a conventional mortgage, but you don't have to actually be stress tested to make the move. What's more is you can actually transition over to that lender, and as long as you can qualify for the monthly payments, you can take on your exact same amortization and exact same loan balance to the new lender on whatever better rates and terms that you're looking for. Now, some of the things that you need to know is that if you're trying to qualify for a new line of credit or if you're trying to qualify before the end of the term, you do not actually qualify for this particular program. So the reality of it is that this particular program is not going to be right for a lot of people because of the ability to requalify and in fact, the ability to adjust or make changes. And in those situations, most people end up just doing a refinance, at which point you can move on to a different lender. Which reminds me, there's a lot of people right now who are paying mortgage rates right now at 6+% that should be looking at restructuring or refinancing their mortgage, and they can move over to another lender. The difference though is that those people have to actually be able to qualify based on today's stress test. So the reality of the new uninsured stress test rules is that they will have a benefit to those people who can qualify, who want the choice of a different lender because of rates, terms, or products, but it's going to be significantly limited. So the reality is it's not going to have a major impact on the overall marketplace. Now, whether you are looking to get access to 30-year amortizations, or if you're someone who's looking to benefit from the $1.5 million or the uninsured rules, there is no doubt in my mind that these rules are going to be massively impactful. And if you're trying to figure out how to calculate your monthly payments, we have a great calculator in the link below, and we have a fantastic home buyer masterclass also in the links below. If you're thinking about getting in the market and you're trying to figure out how to utilize these new rules, along with some of the other changes, go ahead and click the link below.